It's a bitter Monday morning in Chicago. The sidewalks are frozen, the coffee shops are packed, and thousands of people are clocking in for the daily grind. We assume the money we earn from this labor determines how wealthy we are, but earning a paycheck and building wealth are two completely different things. Take Ethan and Lucas. Both are 25. Both just landed the exact same entry-level corporate job. Today, both of their bank accounts ping with their very first paycheck, exactly $3,000. Ethan looks at that deposit and sees consumption. He orders the newest iPhone, books a weekend trip, and immediately upgrades his wardrobe. He trades his capital for instant lifestyle upgrades. Lucas looks at the exact same $3,000 and splits it. $1,800 goes to rent and food. $600 flows into a liquid savings account. The final $600 goes directly into a broad market index fund. Ethan executes a spending plan. Lucas executes a financial strategy. He actively decides to deploy his money to secure future growth rather than immediate gratification. A year goes by. Ethan travels, drives a nice car, and visibly enjoys his income. Lucas lives quietly, repeating his boring routine of splitting his paycheck and investing a portion of his capital every single month. Lucas's discipline relies on a mathematical truth called the time value of money. A single dollar held in your hand today has a higher economic value than that same dollar received a year from now. Money in the present can be deployed to earn a yield. If you delay deploying it, you pay a steep opportunity cost by missing out on returns. At the exact same time, everyday inflation quietly eats away at your purchasing power. A dollar sitting idle over time physically buys fewer goods. Lucas isn't stuffing bills under a mattress. He is purchasing time. Every month he puts capital into the market, he captures the yield and protects himself from the slow decay of inflation. Securing early capital captures a mathematical advantage that degrades the longer you wait. 10 years pass. On paper, Ethan looks highly successful, surrounded by high-end lease-ins and modern apartments. His actual net worth is exactly zero. Lucas still lives simply, yet his portfolio is violently accelerating upward, generated entirely from the exact same corporate salary. Linear savings add up predictably. Invested capital behaves differently. It earns a percentage return. The money multiplies. People expect straight lines, so when the line barely moves early on, they get bored and quit. But left untouched, the math turns exponential, creating massive gains later. The vast majority of Warren Buffett's billions were accumulated after his 50th birthday. He started building his capital base at age 11, giving the math decades of uninterrupted time to run. Massive wealth creation requires a long timeline, far more than it requires a massive initial income. Markets eventually break. A severe recession rips through the industry. Layoffs hit immediately. The paychecks stop, but rent, insurance, and medical bills demand payment today. Financial survival depends on liquidity, the speed and ease with which you can convert the things you own into spendable cash to cover immediate obligations. Ethan owns thousands in tech gadgets and designer clothes, but he has zero spendable cash. To eat, he swipes his credit cards. He accumulates high-interest debt that immediately triggers reverse compounding against him. Lucas taps his 6-month emergency fund. Because he has a cash fortress sitting in a basic bank account, he pays his rent directly. He never touches his index funds, allowing his investments to stay in the market through the entire downturn. You maximize returns during a bull market, but maintaining strict liquidity is how you survive crashes. In the aftermath of the layoffs, Ethan panics. Desperate to catch up to the wealth Lucas built, he scrambles into the market. He takes his remaining credit and dumps it entirely into a single, highly hyped tech stock he saw trending online. The tech sector falters, the single stock collapses, and half of Ethan's desperately invested capital is wiped out in days. Lucas structured his own portfolio completely differently. He holds a 500-company index, a percentage of government bonds, and cash reserves. When tech dropped, his bonds held steady. True financial risk is the raw uncertainty of future outcomes. Diversification counters this uncertainty mathematically. Spreading capital across totally unconnected asset classes limits the damage any single failure can inflict on a portfolio. Surviving the markets does not require perfect foresight. It requires organizing your capital so that a single wrong assumption leaves you intact. We jump forward to age 45. The gap between the two men is now permanent. Ethan works 50-hour weeks at a high-stress job to service the interest on his accumulated debt. Lucas is financially independent. The yield generated by his investments covers his living expenses. He chooses to work on projects he enjoys, insulated from the panic of a missing paycheck. Finance is the science of making decisions under conditions of scarcity. It is the process of deciding exactly how to earn, allocate, and grow capital over a lifetime. The ultimate metric of financial success is freedom of choice. You don't need a massive salary to reach it. You need to make optimal, disciplined decisions with the income you have today and let time execute the rest.